I'm going to talk a little bit about Strattec from a manufacturer's perspective. I'm also smart enough to know with the kind of graphs that Mike puts up and the other people and being the last on the agenda, I'm not putting up any graphs. I'm just going to tell you what I've done, what we've seen, what we've experienced, and what we're kind of anticipating going forward here. It's also important for you to understand from where I'm coming from, not only from the automotive side with Strattec, but as is just stated, the involvement with the arts here and development in Milwaukee. The arts have gone through a really difficult time. Being nonprofits, people not willing to come to the shows to support. When you're not coming to the shows, you're not giving donations to support that. A really key part of our city, and it was mentioned earlier. I think Mike mentioned it on how important the arts are in really the whole character of the city. For the size we are, we're an incredible group of arts opportunities. So that's also been a challenging time. Automotive has not been a cakewalk, I got to tell you that. Just to give you a little bit of background on Strattec, we were founded in 1908. Our name at that time was Briggs & Stratton. Briggs & Stratton was really an automotive company, and it turned out to be a disaster. Okay, so we had an engine that we couldn't use, and eventually got put on lawnmowers, and that's how Briggs grew. In 1995, we had our automotive lock business. We dominated the lock business in North America, owned about 70 to 80% of that automotive lock business. And in 95, we just said, we're too different than Briggs. We split off. So we're a publicly held company now. We have, given the tough times in automotive, we've got a book value of $200 million and a huge market cap of $100 million. Okay, so automotive has really gone through some challenging times, and that's certainly going to influence some of the stories I tell you. We have our headquarters here in Milwaukee. We have sales and engineering in Detroit. We have 4 plants in Mexico. We have a very unique situation of partnerships. We're a public company, but we've partnered for the last 20 years with 2 privately held companies, one in Michigan and one in Germany. Together, to serve the global automotive market, we own 2 plants in China and 2 in India. So it's really quite a spread, and it's the kind of products, talking about key fobs and door handles and latches and all of those really interesting things at cocktail parties sort of push me off into the corner pretty quickly. Okay, so I won't talk any more about that. But here I am at a time of the year where there's a lot of New Year's resolutions and economic forecasts, and Mike just did a great job of that. Again, so that's why I'm not going to show any graphs. But so I'm going to give you my non-economist sort of view on some of these things. We talk about a possible recession coming up, and my view of it is everything I've heard when we go into a recession, what happens? The government sticks in money to try to get us out of that recession. When we look at, and if you paid attention to Mike's graph, the debt of the U.S. going up 20, 30, 40% in the last few years, it really makes you think. We've been in a recession, at least from the automotive side, and the government has been covering that up. What scares me going forward is when they can't keep borrowing at those kinds of levels. And when they start ratcheting back, are we going to have the consumer spending, the consumer confidence to avoid a big recession? So when I look at, and I again don't have all of the graphs that Mike has, but when I look at cash availability, consumer spending, I said, let me look at the last couple of years. If I had $100 in the Russell 2000, where would I be now? Because boy, in 21, terrific year. 22, a bad year. Well, I'd have 91 bucks out of my 100. So that's 2 years later, and let's lay a little bit of inflation on there. That really hurts my buying power, and so from an automotive perspective, that's certainly a concern. I also know that we probably haven't made up that buying power with our cryptocurrency investments. So here we are in a situation where it's a little bit tougher. I also look at the housing market and I say, boy, we've increased our equity in our homes a lot, and that's terrific, but you also have to talk about the access to that capital. And to me, that's very critical. I'm guessing a lot of other people are not as excited about doing a home equity loan when the interest rates are double what they were just a few months ago or a year ago. So when I put all that together and you say, boy, that's what the haves are looking at, then I think about the have-nots. The people are really struggling paycheck to paycheck, and with these government expenditures cutting back, that worries me, not only in terms of the absolute amount, but what it does to the whole confidence level. One thing that I learned in college in athletics early on was confidence makes an incredible difference, and that's pretty hard to put on a chart. But if you are confident, you do things and accomplish things that you'd never dream of. If you don't have that confidence, and if we lose that, and there's all sorts of reasons here that scare me that we may start losing it, that could put us in a tough situation the next year or two. One thing that really struck me the other day, I was watching TV, big news show, and they were talking about the price of eggs, okay? And you were all eating eggs today. Well, it looked like we were doomed, this whole country. And I sat back and I said, well, the price of eggs now for breakfast is going to skyrocket from about 35 cents to 60 cents. And I'm going, if that's what our news media is doing to throw gas on the fire of this consumer confidence, that's going to cause us some problems. So I'm not looking at it as a recession going forward. I'm looking at it as a significant rebalancing. So if you look at the thing in total, it's sort of like a stream that is on average 1 foot deep. Well, that's the average. There's going to be a bunch of things that are 10 feet deep and a bunch that are 6 inches deep when you talk about drowning in an average. And so to me, I think we're going to see rebalancing once again. We saw huge rebalancing at the beginning of the pandemic when everybody was stuck at home and everybody was buying Pelotons and getting a new pet and buying PlayStations, et cetera, et cetera, et cetera. And the restaurants were dead in the water. That's flipping around, and I think it's going to swing back. The same thing has happened with tech, and as Mike just said, and Molly just said, we're starting to see them taking extrapolations of what was some incredible growth and hiring to support that. Well, those extrapolations don't always work that way. Talking about Strattec, how has it impacted us? One thing I've learned is in the tough times, the culture and the communication are absolutely critical. Mentioned that I had a furniture company, One day my factory burned down. It kind of wrecked my whole morning and a few other mornings, okay? But what I learned from that, and the team pulled together incredibly well, was communication was critical. So what have we done at Strattec? For the first year and a half of this pandemic, I've been writing an update to all of my employees twice a week. I tell them what's been happening, what I think is going to be happening, what I was wrong about last week, what we can do to reduce some stress or help some health, things like that. What it's done is it aligns people's thinking. They're not sitting around imagining the worst, and it really gets people going. So the communication and the fact that there's a light at the end of the tunnel really makes a difference. A thing that I think it could have a very, very significant impact on the economy going forward is inventories. What has happened, I'll give you an example. At Strattec, we normally would carry about $55 million of inventory. For the last couple of years, we've been carrying between $75 and $80 million of inventory. Why are we doing that? Because I don't want to shut my customer down. My customer has told me, gee, if you shut me down, I'm only going to charge you $40,000 per hour. Okay? So there's no way I want to shut the GMs or the Fords or the Chryslers down. And so what was happening, and I believe with us, and I believe with a lot of other people, and I got to tell you, we're fortunate because we have a strong enough balance sheet to support that. But what we're seeing is, at times when things were tight, we were ordering more than we needed. Okay? Now let's talk about this rebalancing again. If we get confident in what's going forward, I don't even need to order what I'm using every day. I'll order a lot less, and pretty soon all of these suppliers who've been working 24/7 and making a ton of money for the last 2 or 3 years, all of a sudden their order rates are going to fall off of a cliff. So it's not just Strattec. I see that in some of the graphs of retail inventories and everything. I sit on the board of Jones Dairy Farm, a sausage company. All of the grocery stores are ordering 20% more than they really want. Okay? And that's what we've been having for a long time. So the whole inventory thing is something that really concerns me. We have 2 strategies at Strattec that we've been communicating. Okay? One is the bear chasing you strategy. And I'm sure you all know that, but I'll just repeat it anyway. Okay? The bear chasing you strategy is you don't have to run faster than the bear, you have to run faster than one other person. So, that's why we're carrying inventory, that's why we built inventory. We want to make sure somebody else shuts down our customer's plant and they get charged $40,000 an hour, not us. Okay? The other strategy that we've had, which has been a real benefit to us, has been the riverboat captain strategy. And what we're so used to doing things, we all have habits. It only takes 6 to 8 weeks to confirm a habit. There's things we've been doing for 10 years, 20 years. We've said, gee, a riverboat captain can only navigate to the next bend in the river, take an assessment of where we are, and then navigate to the next bend in the river. The last 3 years, there's been a lot of bends in the river. And I found one of the benefits of that is we have a workforce that is far more flexible, more willing to pivot, less stuck in the old ways of doing things. And to me, that's been a real plus. From a workforce perspective, again, beyond the communication, what we've done is in building inventories, rather than laying people off, that's a critical inventory that we don't want to lose those people. We didn't lay anybody off. What we did is we built inventories which gave us an opportunity. It gave us an opportunity to rearrange the factory and make the parts flows and everything far more efficient than they were, because over the last 20, 30 years, as you buy a new piece of equipment and you'd like to put it here, but there's already a piece of equipment here, so you put it over there, and you have a logistical nightmare. So one of the benefits of this pandemic is long term, we are now going to have a far more efficient factory than we've ever had before. Supply chain, we see that getting better. It's certainly not fixed. We're still worried. We're still sitting on a lot of inventory. But something happened recently that kind of shocked me. For the last 3 years, we've been saying, how do we get enough semiconductor chips to make sure we don't shut somebody down? One of my purchasing people said, gee, I just ordered 20,000 chips from this, I'll leave the company unnamed, and they came back to me and said, I don't want to give you 20,000, could I sell you 70,000? I go, wow, is that a change? Now that is happening at the same time that shovels are going into the ground for all the chip manufacturers to build bazillion-dollar plants to do more and more chips. And I'm saying, again, are we going to be out of balance again a few years down the road? And on the good side, not as a chip manufacturer, but as a customer, and we'll see what happens. Everything is going international. We've got an international interdependence, like it or not, and all of the things that have been happening in China have been absolutely crazy. Okay, and we get a lot of things from China. We have plants in China. I'll give you a couple of stories. Back in April, one of our plants, we normally have about 1,000 people in that plant. And the Chinese government said, we're shutting down because of COVID. That was one evening. We had 52 people in the plant, okay? They wouldn't let them out of the plant for 5 weeks, okay? So if you think we got some problems, we got some major problems. We spent 6 months trying to move a manager from Germany to China. Okay, we finally got him on a plane, and he was supposed to land in Shanghai. While the plane was in the air, they announced, we're not going to Shanghai. We're going to another city, and we're going to drop you off at this lavish hotel behind brick walls with barbed wire and bathrooms which are nothing more than a hole in the floor, and you're in quarantine for 22 days. Okay? So the kind of flexibility that China is going through. Now, the same manager has now been there since last June. So he just told me the other day, I've been here 178 days. I've only been tested for COVID 192 times. Okay? When we talk about rebalancing, that's what was going on. And then all of a sudden, China opens up 100%. The next week, we only had 80% of our workforce with COVID. Not a slight problem, okay? So now after a week or two, we're down to 5 or 10%. But this rebalancing issues and supply chain and how that's going to impact things are incredible. I look back only a few weeks ago, if you looked around the Ford plant, you would have seen 70,000 pickup trucks. Not because people don't want them, they were missing a few parts. It doesn't take much to hold up the whole manufacturing process. So we look at the supply chain as an issue, onshoring. We talk about, let's just move it from China to Mexico, which is a very viable, that's not going to happen overnight. And by the way, the dollar's gotten strong against virtually every currency except the peso. So now it's more expensive. Oh, and by the way, Mexico said last January, minimum wages are going up 15%, government mandate. Okay, well this January they said, I think we'll bump them up another 20%. So you're starting to see incredible inflation in areas outside, and the interdependence we have is incredible. Automotive market has generally been producing at about 80% of what they've would like to be producing at because of all these supply chain issues. If you look at the amount of inventory on dealer lots, we normally have 77 days of inventory. Right now, we're somewhere around 20 days, about 25% of what we normally like. So that's one comforting piece of information for me, because even if we do have a recession, automakers maybe they won't go back to 77 days of inventory, but they might go to 30 or 40 or 50 days of inventory, which means that's going to keep going and that will go well. Other things that are happening in the automotive industry is everybody's looking at electric vehicles. A few years ago, they were looking at driverless cars, which was not exactly the smartest move in the world, but now electric vehicles. We're seeing some real imbalance now. In China, 25% of all of the new cars are electric. In Europe, 10%. In the US, 5%. 6 months ago, the US was predicting 65% would be electric by the year 2030. That's now down to 35, and I won't be surprised if it's lower than that. We have all sorts of issues in the automotive industry. One of the reasons we've struggled is we have 5-year contracts with our customers and fixed prices. We've seen zinc double, we've seen steel go up, we've seen aluminum go up, and we've gotten squeezed, even though we've built in all of these efficiencies, and luckily we have, both to reduce our costs and because trying to keep the labor here is been a challenge. So basically I see, lots of reasons. Is there some optimism? Yes. But if we're going to onshore, we also have to do a lot more investment in automation, and you only do that when you've got confidence. And we definitely have to do something on immigration, because we just don't have the people to handle it. So rather than me coming up with a prediction, and I know I'm out of time, what I did is I said I need to talk to somebody smart who I can pass along a prediction, okay? And so what I found was, and I will wish you all this week a happy Chinese New Year. And this is the year of the rabbit, okay? So what does the year of the rabbit mean? It means this: investments are likely to be a sore spot, with losses more likely than gains. We may be pulled in different directions, but the difficulties will be temporary. There will be greater pressure on expenses because incomes won't follow quite as quickly, and their advice is curb your spending. So I'm normally looking at the glass more than half full, but I got to tell you, after 3 years of getting beaten up through this whole automotive industry, I have been a little bit more conservative and a little bit less optimistic, and know full well that whatever I think is probably going to be wrong, including what I just told you. And I hope so, okay? But that's what we've learned over the last 3 years, and I appreciate that none of you snored too loud while I was talking. So thank you.